Today what I'm going to be doing is I'm going to review a swing trading system using pivot days that helps you locate the best trading setups. Now a little bit about me before we get started. I originally am from Chicago. I made it out to the West Coast a couple decades ago and got into the computer industry, became a software developer, a programmer, and had a chance to cut my teeth on developing some real good accounting systems and stuff for Fortune 500 companies, and done a lot of work for defense contractors and whatnot. But I got to cut my teeth on some really sophisticated types of software systems, and about 10 years ago I shut everything down and focused my attention on the markets, trading my own accounts, and developing my own trading systems. So I get to spend all my time basically, working with the markets. I'm trading every day, and in the evenings, on the weekends, I'm developing and testing systems to try to, build a better mousetrap. Now, one of the problems that we run into, as we all know, is in this game of technical analysis is analysis paralysis. Many of us have great trading libraries, and we bought all the indicators and taken all kinds of courses, but it's, making consistent money is elusive. And so one of the issues is that, I can get into this a little bit further, but mostly what happens is folks have short attention spans, and if you're trading live too quickly and losing money, you're likely to jump ship and try to look for something else. So what it really boils down to is finding a strategy or a system that works consistently, and then following correct money management to make sure that you're not wiping out your account. So let's get started. I want to cover some basics about swing trading, and then I'll get in and review the new system, the new strategy that I came up with. There's 5 big stock market mistakes that I've seen that lead to failure. So if we can just avoid these mistakes, then that's half the battle, right? The first big mistake is a premature purchase of a stock. And this is where you fall in love with the stock, maybe you've read some articles about it, maybe your friends are buying the stock, you see it recommended on TV, whatever, and you just got to get into that stock because you fall in love with the company, even though that stock might be in a downtrend. So you're buying that stock prematurely. If you're going to buy stocks to move to the upside and you're investing for maybe the longer term, you want to buy the stock at the right time. Okay, that's half the battle. The second mistake is lump sum investing. Lump sum investing is where you basically just take all your money, you put it in the market all at once. And this happens actually quite frequently. Somebody might inherit some large chunk of money, and they turn it over to some investment guy, and he dumps it all in the market. I've seen that happen many times. And the problem with lump sum investing is you're basically, betting everything around one price level. If you're right, it can work great. If you're wrong, it can wipe your account out. So lump sum investing is something to be avoided. And I'm going to show you, as we go in further, one little plan to avoid that. Another big mistake that a lot of folks make, and I've made this mistake too, is averaging down, especially into margin. My second year in trading, maybe 15 years ago, I wiped out my entire account doing just this. The issue is you're in a stock or stocks that are such great companies, right, that you've got to buy more because the price is a better value, right? The price is a little bit lower, hey, buy more. And you fall in love with these companies so much that when you run out of money, you start buying more shares in margin, because what you're doing is you're basically betting on maybe the market's going to go back up, the stocks are going to go back up eventually. And what happens is once you hit your margins, the bank wants all its money back, and even though you've taken big losses in the account, they want all their money back, and then that leaves you with zero. So it's an easy thing to do. People do it all the time. I did it once. putting all your eggs in one basket. That is where you basically focus everything on one company, and again, if you're right, it could be the greatest thing in the world. If you're wrong, you can wipe out your account. One of the issues with stocks, and the way we make money with stocks, and swing trading and position trading for 6 weeks, or like short-term investing for a year or whatever, is we're holding overnight. Our biggest risk in stocks is holding overnight. That's where we can get these news-induced price shocks, big gaps against us. They can be real nasty. I've heard of several examples, and there was just somebody a few weeks ago that took a big, I think it was a short position on earnings. And a few years ago, there was a gentleman that shorted Google the day before earnings because he was convinced, I think he shorted a couple hundred shares even, he was convinced they were going to blow the earnings. Google gapped up $80 the next day, and instead of actually like coming down, it floated higher for about 3 more weeks, right? So that guy really got burned on that bet. And that was putting all your eggs in one basket. So diversification is basically kind of splitting things up into different positions. Now, diversification is a double-edged sword. Over-diversification, you're going to end up with mediocre results. I've seen people that are into 35 different stocks. That's not going to do anything for you. You're diversifying so much that you're diluting the profit potential of anything. And then you're just creating headaches for yourself with lots of accounting, lots of commissions, that's a lot to manage. So a good number, in my opinion, for swing trading is anywhere between 3 to 8 stocks. I usually focus on trying to maintain about 5 different swing trades around the same time if I can. You don't have to. All right, the biggie is not using a protective stop loss. Now, we could debate about all the pros and cons of stop losses, getting hit and this and that, but the truth is that most of our biggest catastrophic losses could have been prevented by just having a stop in place. Again, I've made this mistake even when I knew better many times. You let a stock get away from you, and you reanalyze things, and you decide, hey, I got to give it a little bit more time, and maybe you get busy and you lose track of what's going on, and by the time you come back, that stock is long gone from your entry in the wrong direction. I've done this several times in my early trading career. I took one trade I took a fairly sizable position, and what could have been a relatively small stop of maybe $800, and I would have been out in a week, and I would have freed up the cash, turned into like a 9-month drawdown that in the end, when I capitulated, was I think it was a $6,000 or $7,000 loss, right? Tied all that money up for all that time, and then I ended up with a loss anyways. So again, we could debate about all the pros and cons, but the important part of a protective stop loss is to prevent catastrophic loss, which is one of the things that will kill you in trading. Okay, so let's talk about the basic concept of swing trading, and then we can get into some cool stuff. The concept of swing trading, I talked about all the mistakes. Now let's talk about kind of what we want to look for. One of the previous, actually several of the previous presenters that I happened to hear talked about the importance of the trend. And when I first started out hardcore trading, I kind of fancied myself as like this counter trend shorting expert, because that was kind of the cool thing to do. And I developed all these counter trend short setups and trading techniques, which I still use occasionally when the conditions are right, but I mainly focused on shorting. And what I found out, as cool as it was I could have just taken a trade 3 weeks before and made 10 times the money versus the 10 shorts that I was trying to play, right? So that's where the light bulb really went off, and I realized, the reason the trend is our friend, it's not always our friend, it can stab us in the back because trends can change at any time. But the reason that trends are our friend is because in this example here, what we have is when we see a stock starting to move into an uptrend, it's basically because it's under accumulation. And what that means is, institutional players, mom-and-pop investors also are buying and they're holding the stock. So they start eating up the float. All right? And it's just like avocados in the supermarket. When there's a glut of them, like a ton of them available, the price goes down. When there's a little teeny box, they might have the $4 each, because people will pay it. So the point being is that accumulation, when we see a stock in an uptrend, accumulation is telling us that that stock is under favor. The majority is wanting to buy and hold that stock. Now, the basic swing trading pattern is we look for and identify a trend, and then we wait for a pullback. That pullback could be 2 days, 3 days, 10 days. We wait for the pullback, and we want to enter on the pullback, and what we're looking for is we're looking for the trend to resume. Okay, so now let's talk about a couple things here on this slide, because this is a kind of an important thing to get down. First off, why do we care about entering on a pullback? If this stock is in a good uptrend and the 3 weeks out or a month out it's going to be much higher, why do we even care about worrying about this? Why don't we just jump in randomly and we'll set a stop somewhere, and 3 weeks out it'll be a bit higher? Well, there's a couple of reasons we want to go to the extra work to work with this pullback. I mean, you could jump in anywhere and put a stop in, cross your fingers, and hopefully the trend continues. One of the reasons we like to trade on a pullback goes back to what I just talked to you about, which was not using a protective stop loss, right? So if we're taking a trade and we have to use a stop loss, we have to calculate where do we put that stop loss. Now, if we're just going to buy randomly, we're going to have to put a stop loss a lot wider so it doesn't get hit, because we have to take into consideration the range that stock might make up and down over near our entry point. So waiting for a pullback, if you think about it, lets us actually get a tighter stop in, because we're waiting for that stock to pull back maybe 3 to 5 days, and then we can get a much tighter stop in right below where we might see a pivot, which I'm going to talk about, and that allows us to take a bigger position. Okay, so it basically helps us with our leverage a little bit by using a tighter stop, a better position stop. When we get a stock in an uptrend and then we get a pullback and then we put in like a pivot, we're going to have much better odds by using a stop there than just taking an entry and randomly placing a stop. Okay, so that's an important concept to get. That's why your swing trading setups all wait for a pullback. What happens is when a stock's under accumulation, it's going to be rising because, again, the float is decreasing. And it's, when you kind of average everything out over day after day after day, that price is going to be rising at a particular angle, and you can usually plot those with a 20 or 30 day moving average, and you can kind of see what that accumulation rate is. Okay. However, because there's lots of traders, short-term traders, we get in and run the price even further. We push it past the current value area. And then, of course, short-term traders want to jump out and take a profit, so then they sink the price back. This is why we get the up and down zigzag in price movement. Okay, so what we're doing is we're trying to fine-tune our entry. The other thing is we don't know how long a trend is going to last. Not all trends last. I mean, you could see a stock that was in a trend for a year, right? You're looking at the chart, and the price is up in the right-hand corner of the chart, and way down in the left-hand corner a year ago is the price, so it's been trending all year. But for every one of those we see, there's probably 50 other stocks that the trends collapsed midway or before they ever got off the ground, right? So if we just randomly buy, and we happen to buy at the top of like one of these little mini up cycles, right, the swing cycle, it could be our dumb luck that that's exactly where we buy, and that's where the stock turns and moves lower on us, right, even for the long term. So that's why we focus on this pullback. Now the goal of swing trading is to capture short-term profit in anywhere from 2 to 5 days after a brief pullback or a period of consolidation in price. The average on swing trades, if you're going to be, and this depends on how you want to take your profits. How you take your profits is a separate issue from how you take your entry. I mean, they can be related, but basically somebody could enter on a swing trading entry and take their profits in a couple days, or they could hold that stock as long as it's moving in their favor for the next 6 months, right? It's a swing trading entry, but one is a short-term exit and the other is a hold. So, you know, we've got trades that last 2 to 3 days. We've got trades that can last 2 to 3 weeks. I found for myself that the average tends to be around 5 to 8 days. If I was going to crunch all my numbers over the years, it's probably around 5 to 8 days. 3 goals of swing trading. Now, and this actually goes for any kind of trading. We would like to have more winners than losers, and we want our winners to be bigger than our losers. And like I mentioned, no catastrophic losses. Now, it's possible you can make money, and you know, there's tons of investment books that give you these examples. It's possible that you could have more losers than winners, but as long as your winners are really huge and your losers are small, you can still make money, and that's true. But why not have both, right? Why not have more winners than losers and bigger winners than losers? So if we can just follow these 3 goals, we're going to make money by default in the trading process. Trading is not a one-time bet. It's a process that plays out over the series. So keep this in mind. This is what you want to focus on. Now, one final thing, important fact to remember here, you cannot make consistent profits in swing trading by reading today's fundamentals and acting on that information. Swing trading is, well, I'm going to say almost 100% technical. We have news events that can get in there and throw a monkey wrench in things. And here's the thing, you know, fundamentals, you could try to trade off of fundamentals and it might work for you for a while, but it's probably more of an accident or a coincidence. There's not a real good relationship to today's fundamentals and the current price. Now, that being said, fundamentals are good to help you with your stock selection if you like. You know, if you're going to be more of a long-term holder, right, you're going to want to maybe include some fundamentals to help you pick your watch list, because those are the stocks that are most likely to accumulate further out in time. If you're just a short-term swing trader, you can just trade off of technicals. Now let's talk about system design, because I'm going to be reviewing like a little swing trading system for you here that I put together, strategy. And before we do that, let's talk about the implications of system design. One of the things with systems is that, let's say that we put together a basic system. Every change or tweak that we make can have far-reaching repercussions. So in pretty much everything in trading is a double-edged sword. You change one thing, it can help another, but it screw up something else. And that's one of the issues that we have. You know, after we get basic setups, right, after we develop any kind of a basic setup for whatever, day trading, investing, you name it, once we get that basic setup, the next step is how do we filter down the losers, right? I mean, if we've got a decent setup that works, but we're detecting that it happens to pick up various losers along the way that helps you know, draw down some of the profits, how can we eliminate those, right? So we'll build like various filters to help protect us and keep us out of those losers. However, the problem is what we might end up doing is we might also filter out a couple of the big winners. So we end up shooting ourselves in the foot. So this is why system design is, coming up with a good setup is not that difficult, but everything that comes after it is where things have to integrate and things get a little bit difficult. So, it's like a Rubik's Cube. You change one thing, it screws up another. So this is one of the key things in system design that we have to focus on. We want to have just enough to work and give us our good setups and our good strategy that's going to be profitable, but not too much, and everything's got to be integrated just right. Okay, so that's about system design. Now let's talk about trending statistics. We've probably all seen the numbers out there. The 70% of the time the market's stuck, and only 30% of the time it's trending. And now that may be true, and at different times we go into different ratios, but it's going to be definitely different for every stock. I mean, you could have a stock that's been in an uptrend for 6 months, right? So it's been trending 85% of the time, and then you can have a stock that's been stuck for 6 months. So you could say, hey, it's been non-trending for 80% of the time. So it's going to depend on the stocks that you pick and that are actually in trends. And so, like one of the other presenters mentioned, is that this is the area we want to focus on. We want to focus on this trending area because this is where we're going to get the most bang for our buck. It's not that you can't get in here and do fancy footwork and do short-term trades and whatnot, but that's more for the gunslinger. If you want to be more of a conservative trader and not be too technical about things, you're going to have a much easier time in this game, swing trading, when you're focusing on this trending period. Okay? Now, a stock in an uptrend, as I mentioned before, it's under accumulation, and we can slap any kind of moving, the popular moving average is like a 50-day EMA that a lot of folks use. And when we see that angling up like this at this trajectory, that's basically telling us that stock's under accumulation. We look for the higher highs, the higher lows, and again, it's a rally, a surge. We hit an overvalued, short-term overvalue. We pull back somewhere to support. This is the basic concept. So now let's get in and start talking about the strategy that I'm going to review with you today. First of all, what is a pivot day? A pivot day, there's a lot of names that are used when you're reading about them or people are talking about them. Some folks use the term swing high, swing low, ringed high, ringed low. That comes back from the old days when people actually, before computers actually got charts in the mail, and they'd open them up and they would draw circles around the highs and the lows and whatnot, and that's where that term came from. A reversal high, reversal low, fractal high, fractal low, buying climax, selling climax. And that's really what a pivot high or a pivot low is. It's a buying climax or a selling climax. Not to be confused with day trader floor pivots. That's something different. Okay? So here's our pivot days. Pivot low, we have one bar that sticks way down, and so what you're looking for here is you're looking for bars that are, the lows are higher before and the lows are higher after, right? That's your pivot low. The pivot high is just the reverse. We got one little bar that's the high sticks up like a little antenna, and the highs are lower before and lower after. So there's your pivot highs and pivot lows. And what you can do, like I just said, you could actually go, if you still have a printer, I haven't owned a printer probably in 10 years, if you print out a chart, you can actually draw circles around, and you'll notice that pivot highs and pivot lows are all over the place. A while back, I knew about pivot highs and pivot lows, and I thought, they're interesting and whatnot. But when I realized just how ubiquitous they are, and the fact that if you look at them, they tend to be harbingers of change in price, right? We're getting the climax selling, the move down, climax buying, okay? So they're all over the place. They tend to be harbingers of change of direction. And so it dawned on me, they actually make an excellent starting point to build a strategy off of. All right, so that's what we're going to talk about. Now, your official, pivot high, for instance, is 4 days before and lower highs before and 4 lower highs after. Okay, this is your official pivot high. I'm going to show you a variation in a little bit, but this is what you want to look for. Now, the swing trading strategy or system that I'm going to present here today has basically 4 components that it uses. And what I try to do here, folks, is this. We could come up with all kinds of setups. You can scour the internet. You're going to find 100 swing trading setups. I've developed probably 24 of my own custom swing trading setups. The setups are all over the place. And so what happens with a lot of folks is we get hung up on setups, right? We're always looking for the next greatest setup. And one of the issues is if a setup actually works and it's good, you're going to find that a lot of setups are basically signaling in the same exact area, right? They have a habit of doing that. I've had people share like these secret magic setups with me, and I go, yeah, but that's just like a moving average crossover. I'm like, oh, you're right. So the setup, there's more to a strategy than just the setup, and this is where a lot of folks go wrong. Is they stay focused on setups. When one setup doesn't seem to work really good, they start searching for a new one. And setups are fun, right? They're like a little mousetrap that you get to work with. But there's a lot more than just the setup. The setup is just the vehicle to get us into the market, into a position. So what happens is folks get really hung up on the setup part, and they make that really complicated, and they don't fine-tune the rest of the process. So one of my goals for myself a decade ago was to, after I spent lots of time researching and coming up with all these different setups and techniques to get into the market, I decided, hey, I want to come up with a strategy that goes back to basics. It simplifies everything down so that we're not hunting for 20 different setups, having to look at all kinds of charts and whatnot. And what that does, it simplifies the process, and it reduces the amount of time that you're going to have to spend in this as well. Now, in this swing trading strategy, there's basically 4 things that it's going to be doing, or there's four components to it. One is we're going to be keying off of the pivot high and the pivot low days. We're going to be using a good old-fashioned downward sloping trendline break, okay? And we're going to be using a key moving average crossover. And then we're going to have a specialized way to compute our buy points. And that's it. That's all you need. We don't need any other indicators. We don't need multiple time frames. We don't need any kind of other computations or formulas. So let's go through this. So we know, I'm going to give you an example of the pivot high and pivot low here in a minute, but we're going to key off of a pivot high. We're going to use a downward sloping trend line break. Sorry, I had to clear my throat there, folks. We're going to be using a downward sloping trend line break. Now the issue here is drawing the trend line, because if you get 10 traders in a room, you might end up with 10 different trend lines that they draw on the charts, right? Your books will tell you, you want 3 contact points, or from the highest high to all the, cross above all the highs. And the issue with the problem, if I just said, draw a trend line, you might not draw it correctly. What I did is I came up with a methodology to draw, for this strategy, to draw the perfect trend line every time, and it's mechanical. right? So when you learn the way to draw the trend line, it's super obvious and it's going to work. There's no deviations on the trend line. Then we're going to use a key moving average crossover. Now, moving average crossovers moving averages get a bad rap. You know, they're lagging and the crossovers strategies don't work and blah, blah, blah. And, you know, the reason that moving averages got so popular is when people started getting personal computers. Before, you know, people were having to do stuff by hand, and as soon as you could get a charting program that would instantly draw moving averages, that was just like pure magic, and people went to town with that, and you had all these moving average systems developed. And the problem with moving averages is that if you just used like a moving average crossover, yeah, you're going to get, you know, if you've got a stock that has made a huge move to the upside, you can go back and you can see where your two moving averages crossed over, and you're like, voila, that was like the perfect entry. All right, looks great. That's what sucks people into moving average crossovers. However, the problem is that when the market gets range bound, your moving average crossovers can whipsaw you quite a bit. Now, instead of just saying, well, moving average crossovers don't work, let's abandon them, you know, they suck, we're not going to use them. They do work, but we got to filter out the times they don't work. So the first thing is you're going to learn two moving averages that are not used widely that I've ever seen. These are unique moving averages that are all your charting you have them in all your charting packages, no problem, but these are optimized for the swing trading cycle. They're different from what everybody else uses. So you're going to learn those, and then you're going to learn how the trend line break and the moving average crossover, they help filter each other. All right, so that avoids the whipsaw of the moving average crossover problem. And then computing the buy points. All right, so this strategy is going to give you a way to compute the buy points, and again, it's totally mechanical. So one of the nice things about this system is it's you know, back to basics. It's easy to implement. It doesn't require a lot of indicators or anything on your charts. It's very clean, and it's very mechanical. Also, you're going to know where that initial stop is supposed to go. You're going to know exactly where to trail your stop loss on your trades, and you're going to know how to compute compute momentum targets. A lot of times, it's good to one good methodology is if you get a real forceful, quick move in your favor, you can basically cut the position in half. You're reducing your overnight exposure, and then you're basically you can get your position to a no-lose position, right? Because you can bring your stop up now. Let's say you make a quick 5% gain, you sell half, you bring your stop up below 5%. Now you can't lose, you know, other than a catastrophic gap, but you're basically doing what you can to protect yourself. Now, the two key moving averages that this strategy uses are real good because it's a real visual thing. You're going to see one is a slow moving averages, one is a fast moving average, and then we've got price. So this tells us when we look at a chart like this, instantly we know, hey, this stock is in a downtrend. Why? Well, our moving averages are pointing down. Our fast moving average, the light blue, is below the slow moving average, and the price is below both. That's a stock in a downtrend. We're not going to touch stocks like this. See, avoidance is half the battle. So we want to focus stocks that are in an uptrend. So this tells us instantly that this is a stock that we're not going to work with. Now let's say that this is like one of your favorite stocks, or this is a stock that you do want to invest in, then that's fine. Keep it on the sidelines in a watch list, and you're going to wait until we get the macro signals to start working with this particular stock. And hey, it doesn't matter, you're not going to miss anything. In order for this stock to go up, it's going to trigger our macro signals to start the process. Okay, can't miss anything. That's the biggest fear, and that's one of the reasons that stock traders and investors make the mistake of premature, taking positions prematurely, is because they think they're going to miss something. I used to feel the same way. It's like, the story on this stock is so great and so good, I got to get in now. I could wake up and the thing could just be gone. Yeah, it doesn't really work that way. I mean, once in a blue moon you get stocks like that, but typically in order for a stock to turn, you got plenty of time before it's going to start going up. Remember, in this particular example, this is a stock that's under distribution, heavy selling. The majority are not holding. They're jettisoning their positions, right? That's why the price keeps dropping. Now here's an example where we got a stock on an uptrend. So again, very visual reference points. The fast-moving average is now above the slow-moving average. They're both pointing up. Price is up above both of them. That is a stock in an uptrend. Okay, these are the stocks that you're going to focus on. Now, real important in this is how do we spot the change in trend? Okay, what we see is we see a lot of folks, they see a stock pull back and they think, oh yeah, that's the pullback, I can get in, and I'm supposed to wait for the pullback, and this is a better price, I'm getting in cheaper. However, after maybe a couple-day rally, stock plummets again and goes further down. So there's buyers all along here making the mistake of premature purchase, right? So we want to target this change in trend, and that's what this mechanical strategy is really good at. It can target this exact area here so that you're going to start playing the stock on these pullbacks, getting in on these run-ups, okay? Now let's go back to the pivot high. One thing we're going to do in this strategy is we're going to, we're not going to use a 4-4 pivot that I showed you. We're going to use what's called a 4-1 pivot. The reason we don't want to wait for 4 days after is we could miss all the action. So I'm going to show you here, once we get 4 lower highs before, and we have the one little bar sticking up like a little needle sticking up, and then we have 1 bar after, we can anticipate that this is the pivot high and the start of a 4-4 pivot. All right. Even if we're wrong, it doesn't hurt us. Okay. So this is our starting point. When we see the 4 lower highs before and 1 after, this is our starting point. So what I did is I came up with the strategy, and instead of just putting up a bunch of videos and saying, buy my course and here's how to do it, what I did is I built a piece of software. I developed a piece of software that incorporates the training. The videos are integrated right into the software. The training videos are right in the software, and then the calculators that we're going to use are also built in. So you're going to get a combination of video training and the actual calculators that we use. That way you don't have to sit there and do all the formulas by hand. Now the key part of this strategy is what I call the pivot high calculator. I'll tell you a real quick story about this. I'll tell you a real quick story about this. The 11, 12 years ago, maybe a little longer, when I had my office in San Diego, I had some interns come and work for me, and the state college was like right up the street, and so I found some intern students that came and worked. I paid them a little bit of money, gave them a cubicle to work in, and one was a finance major and the other was like a math major, and we worked on a bunch of cool stock market stuff and formulas and whatnot. So the pivot high calculator automatically calculates your buy points. All right. Now I'm going to we're running out of time, so I'm going to kind of burn through here a little bit quicker. In this strategy, what we're doing is we're going to look for our trend line break we're going to look for a moving average crossover, and we're going to look for our first pivot high, I got a spelling error here, that we spot, and then you're ready to jump over and use the pivot high calculator. Okay, so again, this is very mechanical. You can't go wrong. You're going to wait for a trend line break, a moving average crossover, you spot the pivot high, then you immediately just go and use the calculator. The calculator is designed to calculate off of the pivot high based on that stock, on its trajectory, on its range. Okay, it's going to calculate using a formula that the two interns and I came up with to calculate two buy points. So once you put your symbol into the calculator, you're going to know exactly where to buy. Now here's some quick examples where we got the trend line break, we got a moving average crossover, we have our potential pivot high up here. You can see 4 lower highs. Here was our pivot, and then the very first day where we get a lower high, we're ready to go over and use our calculator. Here's a quick example. The calculator computes 2 buy points, then we get our two buy points. You can see on this particular example, it only picked up the very first one before moving on in our favor. Here's another example. We're getting our trend line break, our moving average crossover. You learn the moving average. You learn the 2 moving averages that work with this strategy in the training. There's our pivot high. We get our computed buy points, and again, this one only picks up the first one, but it goes on to work. Now, what's nice about this strategy, again, it's easy on your nerves because all you have to do is you're going to be finding these stocks that are meeting this criteria, and here's the thing, you're not going to miss anything. Nothing takes off without you. You got to wait for the trend line break, the crossover, then your pivot high, and then all you can do is place limit orders in to buy. Okay? And there's some other examples. I probably don't have time to go through these all these in depth. I could spend 2 hours here. Here's an example where you can use this strategy for dollar cost averaging up, okay, versus dollar cost averaging down, which is a no-no, but dollar cost averaging up is actually a good idea. Okay, so this swing trading system is ideal for anybody that is doing 3 to 5 day swing trades, if you're doing trades where you want to stay in for a few weeks, or longer term investors that are using like a dollar cost averaging approach. You're going to simplify your swing trading approach, follow a well-defined trading plan, increase your success rate, very easy to implement, very easy on your nerves. And the greatest thing about it is when you go through the training, you're going to learn how you can pyramid it. You start off very small, and gradually you build your position sizes over time that decreases your upfront risk. All right, so let's just let's get to the chase here. Today, the Pivot High Swing Trading course, it's an integrated course and software. Easy to implement. You get the built-in trading calculators. I'm going to be doing my next live trading on the 25th, so if you get the software, you'll have a couple weeks to work with it, and then it's a live training. You'll be able to ask all the questions you want. The place to get it is you can go to www.tradethirsty.com/swing. This software works on Windows, but you can also put it on a Macintosh if you're using like a Windows emulator. Again, the main screen, you got 4 trainings. Each one is a video that teaches you how to spot a stock that's in a technical trend shift. You're going to compute the swing trading entry points, and you're going to compute your position sizes and price targets. The Pivot High calculator, in the latest version that I came out with this year, I added some new features to it, which is one is you got a swing trading target. That's your very first target, which is going to be based off of, again, the ATRs and the ranges in that particular stock. You get your 2 buy points. It's going to calculate the average price for you, because if you're going to get picked up on both, you're going to basically be working with an average price. And then you're going to get a swing trading stop, and you're going to get a different stop if you want to be an accumulator. Accumulation, the goal is to stay in a little bit longer, so you want to keep your stop a little bit wider. The software also has a fixed risk calculator, and I didn't have time to talk about this, but this is a real important part of the whole strategy. You're not going to guess on your position sizes. The pivot high calculator computes your entries and your stop, but then you're going to turn around and also figure out how many shares you should buy, because what you want to do in the process is you want to fix the risk for each trade as far as dollar amount. You don't want to say I'm only going to lose 3%, because one stock could hit 3% the day you buy it, right? We want to fix our risk based on the dollar amount. The software is 97 bucks. It's yours forever, and it's a complete swing trading system. Again, you're going to learn the 2 key moving averages. You're going to learn a mechanical way to draw a trend line. It's very simple, but it's guaranteed you're going to draw the right trend line. You're going to work off a pivot high, a 4-1 pivot high. You got the calculator to buy your buy points. You're going to know where your stops go. All right, and so you get all this stuff here, 3 videos, the 2 calculators, and again, it's www.tradethirsty.com/swing.